The deep dive is back, and today we're tackling, well, something of a paradox hiding in plain sight. We are diving deep into Banco Bilbao Vizcaya Argentaria, SA. You probably know them as BBVA. Okay, let's really unpack this, because if you hear BBVA and you're maybe picturing a kind of sleepy Spanish lender just, benefiting from rising European rates, well, you're probably looking at the wrong map, actually. The central insight here, the really disruptive thing we want to get across today, is that BBVA, fundamentally, it's a high-profitability, emerging market-focused financial group, a real growth machine.
Right, a growth machine that just happens to be domiciled in Europe.
Exactly.
And that distinction, well, it changes everything. The core tension, the whole investment story for BBVA really hinges on this struggle. Can they keep up this truly best-in-class profitability? We're talking return on tangible equity, root B, pushing 20%.
20% consistently.
Consistently. And they're doing this while operating deep in these, let's face it, volatile markets. High macroeconomic risk, geopolitical risk. So it's this balancing act. Elite performance versus constant volatility. That's what we need to dissect today.
Right. And our analysis, just so you know, is built on a stack of recent investment reports. We're looking closely at their financials through the first 9 months of 2025. And crucially, the immediate strategic fallout from some big corporate events that have basically redrawn their roadmap.
Yeah, our mission here is to give you the shortcut, really, to understand this complex picture. We'll look at two pivotal moments, corporate events that redefine their capital and their strategy. Then we'll break down where that amazing profit actually comes from. Spoiler, Mexico is key.
The crown jewel.
The absolute crown jewel. Then we'll examine their tech advantage, their sort of digital moat. And finally, how they plan to, well, aggressively return billions in excess cash to shareholders.
Okay, so to really get BBVA today, you can't just see it as slow, steady banking history. It's more like a series of pretty radical decisions, right? These two critical pivots that kind of locked them onto this high-return track they're on now.
Absolutely. Not incremental tweaks. These were strategic clarifying events. They brought clarity on capital and, importantly, a mandate from the market. So the first big pivot, that was the Big Bang transaction back in 2021. It was a very conscious decision, a profitable exit from a mature, slower growth market, selling their U.S. operations to PNC.
Right, that was huge. $11.6 billion, all cash. That must have made waves. It wasn't just about the money, was it? It fundamentally shifted their balance sheet situation.
Precisely. That one deal generated roughly $8.5 billion in CET1 capital.
CET1, Common Equity Tier 1, the core measure of bank strength.
Exactly. Purest measure. After that sale, BBVA's CET1 ratio just shot up, put them in a really elite group globally. As of, Q3 2025, it's sitting at 13.42%.
Okay, 13.42%. And their own target range, you mentioned, is 11.5% to 12.0%.
That's right.
So that gap, that buffer, 142 basis points, that's the fortress balance sheet we hear about. How big a deal is that buffer in practical terms?
Oh, it's massive. Huge deal, both, operationally and frankly, psychologically. It puts them way above their regulatory minimums, the SREP requirements. A margin most European banks just don't have.
Right.
It gives them this enormous cushion against shocks. A currency crisis hits Turkey or Mexico's economy dips. They're insulated. This wasn't just being well capitalized, it was deliberate excess capital. It basically took the question of capital strength completely off the table for investors.
So, okay, they swapped a stable but lower return U.S. business for this giant pile of cash.
Yeah.
Suddenly the problem wasn't low returns, it was, what do we do with all this extra capital?
Exactly.
And that set the stage for the next pivot, the big M&A attempt. Which brings us right up to the recent drama. The attempted hostile takeover of Banco Sabadell, their Spanish rival, that dragged on for 18 months, right? Huge uncertainty for the stock. And it finally ended in failure in October 2025.
Yeah, that bid was basically their attempt to use that excess capital for domestic consolidation, build scale in Spain. But it failed. They only got about 25% shareholder acceptance, needed 30%. But honestly, the failure of the bid, that's probably the most important, most clarifying event for BBVA this year.
Ah, okay, this is fascinating. The classic market reaction moment. When the news broke that the deal failed, BBVA's own stock jumped, 6.7%?
Yep, 6.7% rally.
That's about as clear a message from the market as you can get. Why were shareholders so happy the deal collapsed?
Well, they were essentially rejecting the risks and, crucially, the lower returns the merger implied. If that Sabadell deal had actually happened, the general view was it would have diluted BBVA's overall OFTD.
Diluted from that near 20% level.
Exactly, down into the, low to mid-teens probably. at least for a while because of integration costs and Sabadell just not being as profitable.
So the market was basically shouting, no, we don't want lower ROTE, even if it means getting bigger in Spain.
That's precisely it. They saw execution risk, integration headaches, and that temporary ROTE dip. The market mandate couldn't have been clearer. Forget large-scale M&A at home. Shareholders effectively told management, stop trying to do deals that water down our returns, focus on those high-ROTE emerging markets, and just give us that massive capital buffer back.
Wow. And management listened, right? They responded almost immediately, cementing this new path. Organic growth where it counts, and really aggressive capital returns using the money they would have spent on Sabadell.
Exactly. That pivot completely changed the narrative. BBVA went from being a potential consolidator to basically a pure capital returns story.
Okay, now let's get to the core of it. Where does all this profit actually come from? Because this geographic breakdown, it's so important. It forces you, the listener, to stop thinking of BBVA as European and start seeing it through the lens of, well, often volatile emerging market dynamics.
Absolutely critical. In the first 9 months of 2025, over 60% of their net profit came from outside Spain. That tells you where the real engine is.
And Mexico. I mean, it's not just part of the story. It is the story, right? It drove a staggering 48.5% of net attributable profit in the first 9 months of 2025.
Colossal is the right word.
And they dominate there. BBVA Mexico, over 25% market share. It's a commanding position.
It really is. And the numbers coming out of Mexico are just, well, they're exceptional. BBVA Mexico delivered an ROE, return on equity, of 27.1% last year.
27.1%.
Yeah. Now, put that in context. The average ROE for banks in Mexico is around 19.7%.
Okay, so they're running nearly 800 basis points hotter than their local competitors.
Exactly. It shows their scale advantage, their tech leadership in Mexico. It's incredibly efficient.
And here's the tension we talked about. You see that amazing 27.1% return, and then you look at the immediate economic forecast for Mexico, and it's pretty grim.
It is. That's the nearshoring story versus reality gap right now.
Everyone loves the long-term idea of U.S. companies moving production to Mexico.
Sure, the long-term tailwind is there, but the immediate reality for 2025, it's worsened quite sharply. We're seeing major forecast downgrades for Mexico's real GDP growth next year, down to between, say, 0.5% and 0.7%.
Well, hold on, 0.5% growth. How do you sustain a 27.1% ROE in an economy that's barely growing? That sounds risky. Like either they're taking on way more credit risk or those returns are about to fall off a cliff.
That is the multi-billion-dollar question. It dictates the whole valuation debate. Now, management argues, and to be fair, the Q3 asset quality numbers support this so far, that their lending is disciplined. Their NPL ratio in Mexico is actually very low.
NPL, non-performing loans.
Right. Bad loans. So the high ROE isn't just from reckless lending, they'd say. It's driven by top-tier cost efficiency, their digital dominance, and high net interest margins helped by high local rate.
Okay, so their argument is, our franchise is so strong, our tech platform so efficient, serving millions of digital customers, that we can kind of ride out this macro shock, this sub 1% growth, better than others.
That's the thesis. But, history suggests banks rarely keep peak ROE when their main economy stalls like that. If credit demand plummets, or if businesses stop investing because the government's cutting spending, that 27.1% ROE has to feel pressure.
Right.
The discount the market puts on BBVA stock today, a lot of that is skepticism that the Mexico ROE can survive 2025 without taking a serious hit.
Okay, let's switch gears. Turkey. That contributed, what, about 8% of profit?
8.1% in 9M 2025, yeah.
This is a totally different beast, though. You called it a disinflation bet, high risk, high reward, maybe?
Very high risk. It's basically a big bet on whether the current government's shift towards more orthodox, tight economic policies will actually work. They're trying to tame really chronic high inflation. The whole operating environment there is just defined by that fight, that volatility.
So what are BBVA's own economists expecting? What does a success even look like in Turkey right now?
Success means inflation comes down dramatically, but still stays high, BBVA research thinks year-end 2025 inflation might fall to the 30-31% range.
Still 30%.
Still huge, yeah. But a big drop from where it's been. And at the same time, they expect the Turkish lira, the exchange rate against the dollar, to end 2025 around 45.
Wow. Managing a bank in that kind of environment, currency swings, inflation, must require incredible agility.
Extreme risk management, definitely.
Now, I wanted to pick up on a technical point you raised, the hyperinflation accounting, IAS 29. Their recent results showed a lower negative impact from this compared to the year before. What does that actually tell us?
Right, that's a good catch. It's a bit technical, but important. IAS 29 essentially forces companies in hyperinflationary economies to recalculate their financials to reflect the loss of purchasing power. Usually, it results in a big negative hit to the reported profit and loss. So, seeing a smaller negative adjustment could mean a couple of things. One, maybe inflation, at least based on the specific accounting model they use, might have peaked in the previous period. And two, it suggests the most severe accounting pressure could be easing. Now, the economic risks are absolutely still there, very high, but the distortion on the reported numbers might tentatively start to lessen. It's maybe an early, fragile sign that the painful adjustment process is yielding slightly less volatile reported results.
Okay, third EM bucket, South America, about 7.3% of profit. And the big story here seems to be Argentina acting almost like a high beta bet within the group, a call option, as you put it.
Exactly. Argentina is going through this radical economic turnaround effort right now. New government, very market-focused policies. And for BBVA, this has led to, well, frankly, explosive reported growth numbers. The South America segment profit jumped 236% year over year in Q1 2025.
Okay, but again, we need to look under the hood. That massive jump. It wasn't really organic growth in lending, was it?
No, not primarily. The reports explicitly state that surge came from a less negative hyperinflation adjustment in Argentina.
Ah, so similar to Turkey, but even more pronounced. Better inflation currency dynamics meant a smaller accounting hit, which looks like massive profit growth.
Precisely. The stabilization efforts are reducing the drag from that IAS 29 rule.
But there's also a deeper shift happening in the banking system there, right? Moving from crowding out to crowding in.
Yes, that's a crucial dynamic. For years, Argentine banks were basically forced to lend heavily to the government, buying sovereign debt. That crowded out lending to the private sector, starving businesses of capital.
Got it.
Now, with stabilization, hopefully we're starting to see the reverse, crowding in. Capital that was tied up funding the government can start flowing back to private companies and individuals. We could see an explosion in private sector credit just because it's starting from such an incredibly low base.
So if Argentina does continue to stabilize, BBVA's operation there, while small now, could actually become a real growth driver.
Potential for huge upside. It shifts from being just a diversification play or a risk hedge to a genuine, albeit still risky, growth option.
Yeah.
Hashtag 2.4 maturing tailwinds in Europe and Spain.
Okay, finally, let's circle back home for BBVA. Europe and Spain, still a big chunk, 39.3% of profit. Now, banks across Europe, including BBVA and Spain, got a huge lift from rising interest rates, didn't they?
Absolutely. That whole monetary policy normalization cycle was a massive tailwind. It pushed average European bank ROE back up towards 10%. Spanish banks like BBVA did even better, averaging around 16% ROE.
But that was cyclical, right? Driven by central banks hiking rates.
Yeah.
And that cycle's turning.
It is turning. The European Central Bank started cutting rates in 2024, more expected in 2025.
Yeah.
So that peak benefit, that tailwind from rising rates, widening net interest margins, or NAM, that's likely behind us now.
So going forward, profitability in Spain can't just ride the rate wave. It has to come from structural improvements.
Exactly right. The game shifts from a cyclical lift to a structural fight for efficiency. BBVA needs to really lean on its digital advantages in Spain now, keep tight control on costs, maybe streamline branches further, and really focus on growing fee income, income from services, wealth management, insurance, not just the interest rate spread.
Which brings us neatly to their big competitive advantage.
Yeah, we've laid out this picture of, high returns but in very volatile places. The only way you can pull off a nearly 20% ROTE consistently in that kind of environment is if you have a real durable edge. And for BBVA, that edge is clearly technology and just radical efficiency. Hashtag 3.1, the fintech with a balance sheet model. They've really transformed themselves, it's fair to call them, sort of a fintech with a balance sheet. Their core advantage is this global, scalable tech platform. Internally, they call it Horizon. Now, unlike a lot of banks that have, messy, different legacy systems in every country.
Right, a patchwork quilt of old tech.
Exactly. BBVA made a strategic bet years ago to centralize their core platform.
Okay, so having one single platform, Horizon, how does that actually give them an edge? What does it save them?
It creates this huge structural advantage. Think about it. Unified code base. When they develop a new feature, maybe an AI tool for customizing offers or spotting fraud, they build it once, and then they can basically roll it out across Mexico, Spain, South America almost instantly. Just minor tweaks needed.
Ah, okay. Faster innovation, lower cost to deploy.
Much faster, much cheaper, makes them way more agile than competitors stuck managing multiple old systems. Their digital efforts are instantly scalable.
And the customer-facing numbers really back this up. Like 66% of all new customers acquired digitally. That's huge.
It is huge, but the killer stat for me, the one that shows the real operational impact, is that digital sales now make up 78% of their total units sold across the entire group.
78%.
Think about what that means for their cost to serve. Every loan, every credit card sold digitally bypasses the expensive branch network.
Yeah, most banks would dream of numbers like that.
They're not just leading in Spain, they're a global benchmark on digital sales penetration.
And this tech platform, it gives them a way to expand cheaply too, right? Like Italy.
Exactly, that's the capital-efficient expansion model. They launched in Italy purely digitally, no branches, acquired 600,000 customers in 2 years, just shows the power of the platform.
Wow.
And now they're planning to do the exact same thing in Germany in 2025. It's a really disruptive approach for a big bank. Attack mature markets as a low-cost digital player, cherry-pick customers without building costly branches.
That's how they defend their profitability, even when Mexico or Turkey gets choppy.
It's their core defense mechanism. Hashtag 3.2 efficiency and quality trajectory, 2020-2025.
And you can see the results of this digital moat in their financial performance over time. Net profit went from, what, 1.3 billion in 2020 to over 10 billion in 2024. That's not just rates going up, that's structural.
Absolutely structural improvement driven by that efficiency, and it flows directly into keeping that ROTE consistently high, 19.7% in 2024, and they held it right there, 19.7% through the first 9 months of 2025. They are just consistently near the very top of the global banking league tables for returns.
And the efficiency ratio costs divided by income, that's down to 38.2%, and they're aiming for 35%.
Yeah, 38.2% as of 9M 2025. Targeting around 35% by 2028 is very ambitious.
What does hitting 35% actually mean?
It means they have to keep growing revenue significantly faster than their costs are growing, really leveraging that global platform for scale. If they hit 35%, they cement their place as one of the absolute most cost-efficient large banks in the world.
Okay, but here's where it gets really counterintuitive, considering the EM risk we talked about, asset quality. Their bad loan ratio, the NPL ratio, has actually been falling. It's down to 2.8% group-wide.
Yeah, 2.8% as of September 2025. And the coverage, the money set aside for those potential losses, is strong too at 84%.
But the really striking thing, the NPL ratios in their big emerging markets are better than in Spain.
That's the data point that really challenges the skeptics. Mexico's NPL ratio, just 1.6%. South America, 2.2%. Both are lower than Spain's 2.5%.
So how is that possible? How does an EM-focused bank have cleaner books than its home market?
It's the crucial piece. It tells you BBVA isn't getting that 20% ROTE just by taking on a load of dodgy loans. They're getting it through, yes, pricing power and high margins in those markets, but fundamentally through world-class efficiency and seemingly disciplined underwriting despite the environment.
Okay, so we've got high returns, we've got the tech moat, we've got this fortress balance sheet. And especially after the Sabadell deal died, the whole focus just snaps towards capital allocation, right? This is the total yield story for BBVA now.
Exactly. Everything pivots to returning that excess capital. Hashtag 4.1, the core capital allocation philosophy.
And they've been really clear about their policy, which investors love because it reduces uncertainty. It's a two-part approach.
Yeah, very transparent, very predictable. Part one is the core payout. They commit to distributing 40% to 50% of their annual profit each year. That comes via cash dividends and ongoing share buybacks. That's the baseline.
Okay, 40–50% of profits back every year. And part two involves that excess capital.
Right. Part two is the excess capital return policy. This is where the fortress balance sheet really pays off for shareholders. They've explicitly committed to return all the CET1 capital they generate above their 12.0% target ceiling.
So basically give back everything above what they need to run the bank comfortably.
Pretty much. And remember, as of Q3 2025, they were at 13.42% CET1.
Right, 142 basis points above the target.
Exactly. That 142 basis points, given BBVA size, translates into billions of euros earmarked for return. It's on top of the regular 40–50% profit payout. So you get current profits return, plus this huge historical capital buffer being paid out over time. It's a powerful combo. Hashtag 4.2 acceleration of shareholder remuneration, Q4 2025. And the Sabadell bid failing. That was the green light. Management had the market mandate, and they moved instantly to accelerate these returns.
Yeah, the actions came thick and fast. They immediately kicked off a pending 1 billion share buyback in late October. and then paid out a record interim cash dividend, putting 3.2 per share. That was $1.84 billion just flowing out in early November.
Yep. And that's just the start, using the capital immediately freed up. They've also publicly stated they're planning another significant additional buyback program, just waiting on the final nod from the ECB, the European Central Bank.
Okay, so you add it all up. You've
Yep.
got a decent dividend yield, around 4.4% currently,
Mm.
plus these multiple large accelerated buyback programs.
It creates a really compelling total capital return profile, a very high total yield. And frankly, that's the main reason investors might be willing to look past the day-to-day currency noise from Turkey or Argentina. The cash return is tangible and significant.
Yeah, it totally shifts the investment case away from uncertain M&A growth towards just pure, predictable capital yield, all funded by those strong core earnings. Hashtag tag 4.3 management targets, 2025, 2028.
And management is clearly signaling they believe they can keep this performance up. Their forward-looking targets for the next few years, 2025 to 2028, are ambitious. They're basically betting that their structural strengths will win out over the macro headwinds.
But to run through those targets, they're aiming for an average OE over that period of around 22%.
22% average ROTE. That's not just top tier in Europe. That's globally competitive.
Wow.
And that high ROTE underpins the other goals. They're targeting cumulative net profit of about $48 billion over those 4 years.
$48 billion.
And they're aiming for mid-teens growth, CAGR, in tangible book value plus dividends per share.
Okay, focusing on TBV growth is important. It means they expect to grow the underlying value of the bank itself, even while handing back tons of cash.
Exactly. It's not just shrinking the bank via buybacks. It's growing intrinsic value, too.
And we should also mention their sustainability goals are baked into this, right?
Yeah, it's worth noting. They have a big target. Channel $700 billion into sustainable finance, environmental, and social projects between 2025 and 2029. It shows how these ESG factors are becoming embedded in core strategy, often linked to executive pay and long-term risk thinking. Okay, so let's recap. We have elite profits, a strong tech moat, huge capital returns. So why? Why does the market still value BBVA at such a discount compared to that performance?
Right. This is the big question. We have to talk about the risks holding the valuation back. And it comes back to those emerging markets, doesn't it?
It absolutely does. And the most obvious, most frustrating risk is currency drag. It just acts like this constant fog over the results, hiding how strong the underlying business actually is. We saw it clearly in the 9M 2025 numbers.
Yeah, you said underlying profit growth was amazing, nearly 20% if you strip out currency effect.
Right. Plus 19.8% at constant exchange rates. Really strong operational performance.
But then reported in euros.
And boom. The lira crashes, the peso weakens, and that growth gets slashed down to just plus 4.7% in reported euros.
That 15 percentage point gap, that's purely currency volatility.
It's the risk tax BBVA pays. The reported numbers look choppy, less impressive, even when the businesses in Mexico or Turkey are firing on all cylinders locally.
And beyond currency, we have to keep hitting on the direct economic risk. That forecast for Mexico, 0.5% to 0.7% GDP growth, that's a direct threat to their main profit engine, the one generating 27% ROE. Can that really hold up?
Even with great efficiency, a systemic slowdown in your biggest market has to be a concern. It's the biggest macro risk they face right now.
And then there are those other risks, the sort of unquantifiable ones.
Yeah, you have to mention them. Internally, there's still the Villarejo case in Spain, those corporate espionage allegations. It's a headline risk, a distraction, even if there's no clear financial hit assigned yet. And geopolitically, well, Mexico is always sensitive to U.S. politics, trade policy. That's a risk you can't easily hedge. Hashtag 5.2 capital insulation and sensitivity.
Okay, but crucially, while the P&L, the profit statement, gets hit by this volatility, the bank's capital, its core strength, is much better protected.
Yes, that distinction is vital. The risk management seems very focused on insulating the balance sheet. Remember that fortress CET1 ratio. It's designed to absorb shocks. Our analysis showed, for instance, that even a big 10% drop in the Mexican peso only knocks about 9 basis points off their CET1 ratio.
Only 9 basis points for a 10% currency hit.
Yeah. And a 10% drop in the Turkish lira. Even less, just 3 basis points off CET1. That shows they have pretty sophisticated hedging in place, specifically designed to shield the capital base from the currency swings that batter the income statement.
So P&L is volatile, but the bank's foundation remains solid.
That seems to be the approach. protect the core capital integrity at all costs.
And they also still benefit if interest rates stay higher for longer globally.
They do. They remain asset sensitive. Even with the ECB cutting, a hypothetical 100 basis point rise in rates across the board still boosts their net interest income by about 4% in Europe and 2.5% in Mexico. So while the general trend is easing, any persistence in inflation or reversal in rates is actually a net positive for their revenues. Hashtag tag 5tag 5.3 valuation discount analysis.
Okay, so let's bring it all together with the valuation. Elite RTD, huge buybacks, protected capital, but a discounted stock price. Let's put numbers on the market's doubt. It trades at a price to tangible book value, PTBV, of around 1.8x.
Yeah, roughly 1.8 times tangible book. And that ratio, that 1.8x, that's where you really see the market's skepticism crystallized. Think about it. BBVA is generating nearly 20% RTD. The average European bank is maybe 10%. Even their best Spanish competitor, CaixaBank, was around 15.4% in 2024.
Logically, a 20% ROTE bank should trade at a much higher multiple than 1.8x PTBV, maybe well above 2.0x.
You'd think so, especially compared to, say, high-performing banks in Brazil, which also deal with EM volatility but often get higher multiples. BBVA's discount looks quite steep.
So what's the market saying with that 1.8x multiple?
It's saying it doesn't believe the current high returns are sustainable. It's applying this discount because it fears a major shock is coming, probably related to that Mexico slowdown, or maybe Turkey's policies faltering. The market conviction embedded in that 1.8x multiple is that BBVA's elite profitability will mean revert, that the ROTE will fall back hard, maybe towards 15%, maybe even 12%.
So the market is valuing the bank based on potential future problems, not its current performance.
Exactly. It's saying we'll pay a 1.8x book for the bank you might become if things go wrong, not the 20% ROTE bank you are today. It's the price of EM risk, pure and simple, even with the capital hedges. Hashtag tag outro.
Okay, so let's wrap up this deep dive. BBVA. They've made huge strategic shifts. Sold the U.S., ditched the Sabadell bid. They've built this fortress balance sheet. They have this powerful digital moat driving efficiency and enabling cheap growth. And now the name of the game is just maximum shareholder returns through massive buybacks and dividends.
That's the picture. The core investment trade-off is clear. You accept the high volatility, the currency swings, the economic risks in places like Mexico and Turkey, and in return, you get access to truly elite profitability metrics, almost like a tech company's returns, plus that huge capital return yield. The big debate is just, do you believe that high profitability is durable enough to eventually make the market pay a higher price? But here's the final, maybe provocative thought for you to mull over. BBVA's engine room, Mexico, generating that incredible 27.1% ROE. It's heading to its toughest economic patch in years, just 0.5% to 0.7% GDP growth forecasted. The current valuation discount basically says the market thinks that Mexican ROE cannot survive that slowdown intact, despite BBVA's efficiency.
So we know the bank's capital is well protected by hedges, but the earnings are undeniably exposed to that EM volatility. Which force wins out over the next couple of years? Is it BBVA's proven digital strength and efficiency? Or is it just the unavoidable gravity of emerging market macroeconomics? That's the fundamental question you need to wrestle with when you look at that 1.8x PTB multiple. Is it a bargain or is it a warning sign?